Okay, welcome back. You got the market down 600 points and we're about 24,100. It's been, a red day. Although I have to say that compared to some of the other sort of regional markets in Asia, even in Europe, I mean, it's at par or maybe lesser, 2.5% cut today on the Nifty. Dinshaw Irani is with us from Helios Mutual Fund and Devina Mehra joins us from First Global. Thank you very much, both of you, Dinshaw and Devina. Great to have you guys on the program. So, Dinshaw, if we can start by asking you, what are the thoughts at Helios today on what's happening and what is the intel from Helios about what's going on and what is likely to happen from here?
So, Prashant, very good afternoon to you, your viewers and your team. And thank you for having me on your show. So here's the thing, Prashant. In fact, after March, so basically what we've been calling out is that the markets are not respecting the fundamentals. Okay, that was the first thing that we called out earlier. From March onwards, the index earnings, the broader indices earnings have been cut by almost 5%. And what did the market do? It was up 11% till Thursday, I believe. So that's how it was. And in fact, June quarter again, the earnings haven't been that great. At best, it's been flat. If you take out the financials, it's negative earnings growth, right? So obviously, valuations is not the only reasons why the market should correct. They were waiting for a negative trigger, and I think the trigger came by way of the yen carry. I mean, 25 bips hike in the interest rates being increased to 25 bips by BOJ is not a small deal at all. I mean, the last time they did that was in 2007. It took almost 7-8 months for Lehman to collapse. So you never know how these winds are blowing after this kind of a up move by the BOJ as such. So basically, this is the trigger that one was waiting for. I'm not calling out a bear market at all. My feeling is it's a correction in the bull market. But the fact is that these corrections can be very savage. And our feel is that this year itself, I mean, this particular calendar year itself, is going to be very volatile and choppy because they're going to be crosswinds all across the globe going forward. So one has to be very careful. And in fact, that's why you'll see that our portfolios are more or less large cap heavy as such. And we're fairly conservative towards the mid caps. We definitely, I mean, away from the mid caps and small caps, whatever new ideas we're finding out, we are investing in those with obviously where the valuations are appealing.
Devina, come in here. What are your thoughts on what we've seen so far, and what's your sense? Beginning something here, or you think it's just a bit of a knee-jerk reaction?
Actually, the reaction, the view is not very different from what I have said on your shows over the last couple of months, which was that in the shorter term, we were expecting some sort of volatility and correction. However, a 1 to 2 year view was positive. So that was broadly what I've been saying for a while. Of course, we've been fully or partly hedged from March. But as I said, even at that time, that while some volatility was expected, it wasn't as if that I was predicting a major crash in the mainstream indices on a sustained basis. Because of that, we were never in cash. So we were always fully invested. Up until the election results, we were fully hedged, and after that, we've been partly hedged. So, that's the way to play it. To go into cash is only when you expect for sure that more or less a crash is going to happen, which is what we expected in early March 2020 before the COVID crash. But that sort of situation doesn't come that often. And in terms of the orientation, not that different from what Dinshaw said and what I have said in the past, that we had cut back very drastically on small caps for the last few quarters itself, even though we knew that in the short term it would hurt relative performance. So the under 5,000 crore companies where we normally have 14, 15, 13 in that range, sometimes 20%. We've been at 5-6% of our portfolio, so as low as that. So we've again been quite skewed towards the large caps because the small caps is, as a category, is where risk lies and where risk management is impossible because neither do stop losses work because those stocks, when they fall like a stone. Yes, there are no exits. Nor can you hedge them because the only hedge available is a nifty put, which doesn't move along with the small caps. So those are the, those and other frothy areas that sudden industries that take off and where there are a lot of thematic funds being launched. Typically, you can take that as a negative indicator that whichever category in terms of small cap, large cap, etc., or industries or themes where there are a number of funds being launched, that's almost always close to the peak of that. But having said that, on a relative basis, India still looks better than most of the world for sure. And I am laughing at all the explainers of the yen carry trade because, as John Kenneth Galbraith said, that financial markets forget history and therefore the bubble pattern just repeats. So the yen trade carries on till Monday it bursts, and that has happened multiple times, right from the time it was the trigger for the Asian crisis, or one of the triggers for the Asian crisis in the late 90s, and then another almost 10 years later, 9 years later. So this is one more time when the yen carry trade has exploded.
So Devina, are you a believer that a recession is coming in the US? Because I think there was one more rule, that SAHM rule, which got triggered today. And it's apparently been giving, the right call since 1965. So are you a believer in that, that the US is entering into a recession, a hard landing?
It's difficult to say just now because, if you read the daily commentaries for whole of last week, again, this is like cause for some amusement for me because on Wednesday after the FOMC meeting, the markets rallied and everybody had one nice little explanation as to why that rally was justified. Then Thursday, Friday, when the markets fell again, all the commentators, all the newsletters, all the press had one nice little story about why that had to happen. So this is, as I often say, the exact same set of data and circumstances can be used to justify a market rise or a market fall. Interest rates getting cut, wow, this is great for the market. Interest rates not getting cut, that means that the economy is doing so well. So it is, therefore also the market going up is justified. So it is all, these are all explanations, and unfortunately, I would love it if that were not the case. In most macro indicators, there aren't enough data points to say that that something which has happened in the past will repeat, because there aren't enough data points for them to be statistically significant and for all other things to be equal. And the first time you're really finding a slowdown in the U.S. labor market. So whether it goes into an actual hard landing, it doesn't seem exactly on the cards just now because the rate cuts are, I think, not that far off, and it's not as if that there is anything disastrous which has happened on the labor market. It is just that it was not so very buoyant, and now it's not so buoyant. So I'm not very negative on the U.S. economy as a whole.
Reema, the rule that you're talking about is the SAM rule.
SAM rule, yeah.
So she's an economist. She is an economist. She's alive, and she used to be with the Fed, and that's where the rule comes from.
Yeah.
And according to that one, of course, we perhaps may already be in a recession, shallow. It is all kinds, right? So, Dinshaw, come in on what you're doing and what you would be doing, what are the sector preferences, etc.
So today, Prashant, actually going into the budget, we had raised some cash, and fortunately, we didn't invest that cash even after the budget. So we're pretty stable there. I don't think we're in a rush to invest that cash, by the way. We're keeping that cash aside for some untoward event if that happens at all. Plus, what we're doing is that in financials, we continue to be overweight. Frankly, the numbers also are looking okay. They're not that, given the fact that the way things are today, they are looking far better than others who are reporting in the market. So that, and we're not definitely running into safety. We're not going to do that because we don't think you want to park your money in 60, 70 PE stocks with growth rates of 7-8% because I'm sure our economy on a real term does, on a nominal terms does much better than that. So that's why we won't be doing that as such. Consumer is another space that we are pretty overweight on, but not in the FMCG space, like QSRs and all is where we are pretty bullish on. And obviously tourism remains one of our focus areas. looking at the way it was. I mean, we didn't do it proactively, but what we had done earlier was taken an approval for a large cap, mid cap fund, and we are in the process of timing that entry as such. So let's see how that goes. I think that was pure luck on our part, I suppose, getting the approvals in place at the right time.
Dinshaw, we haven't seen a correction in excess of more than 10%. We've seen the markets fall 3-4% in the last many months. And even today, from our recent high or all-time high of more than 25,000, it's a fall of about 4%. But do you think the current global situation can precipitate a correction of more than 10%?
One thing, Reema, that 4% is for the indices, right? I mean, if you look at the components within or in the small cap and mid cap space, I'm sure you'll see quite a few stocks which are down 20-30% from what they were when the indices were high. So this hides a lot, right? So, and secondly, as I said, we're not calling out a bear market at all. I don't think India, if at all, loses shirt, the others are going to move around without their clothes, I suppose. But that's not going to happen, because India is probably one of the only markets which is going to show a growth going forward. So that way we are fairly insulated. But the fact is that equity as a class may become unattractive going forward. And that's why we believe that you're going to see a very choppy and volatile market going into this year itself. I mean, in fact, probably even if the Fed cuts rates, I don't think that's going to impact equities in a big way as such. So that's why we are where we are today.
Okay, we'll leave it there. Thank you very much for joining us, both of you, Dinshaw and Devina. Appreciate your time here on CNBC-TV18, and we continue to sort of, lean on both of you over the next couple of days as we get through this sort of bit of a down phase in the markets as well. So 24,075 is where the Nifty is now trading at.